the interesting thing of this year is if you look at the PE expansion, it's driven the majority of the returns. In fact, the S&P 500 is right now projected to have an actual decline in earnings, and yet the S&P is up, as of today, about 20%. So there's a big decoupling between earnings growth and stock market performance, particularly within tech. If you look at the top 10 contributors of the S&P 500 this year, the average stock was up roughly 82%, but of that 82%, the multiple expanded by 80%. So in other words, the dividend and earnings part was up about 3% for the first half, compared to 82 for those 10 stocks. So really, you're talking about a little bit of a decoupling from fundamental earnings performance versus what's happening with the stocks. And you've seen that now with some of these recent, with Tesla the other day, and so that the expectations are so high, and so the market's getting a little bit of cold water thrown on some of these stocks. We'll see as we go through earnings season, but there's definitely some risk.
Yeah, I mean, decoupling's a nice benign word to sort of explain what some people might call just completely crazy.
Yeah, you could call it crazy. I mean, I was managing money back in the 90s, and if you had bought a basket of stocks at the end of 1999 of the top largest 10 tech stocks, and you said, you think about all the things that have happened over the last 20 plus years. In 1999, very few people had a cell phone. Nobody had a smartphone. The Apple iPhone wasn't out until 2007. We used to do the quaint thing of going to the store to buy things, and we couldn't DoorDash things, and we couldn't go to Amazon. There was no social media. So all of these things that have happened in the past 20 years, and yet if you invested in those top 10 tech stocks, you actually would have, over 10 years, lost roughly 7% per year on average. So you lost about 50% over 10 years. And even if you held them all the way to today, you barely made money. So, if you buy at the wrong time and you pay too much, the moral of the story is, you're going to get burned. But again, when we look at the market, we think there still are opportunities outside of those large kind of names that everybody's talking about.
I can understand that rationale to some extent, but when you're thinking about it, I suppose, from a relative basis, and you were to strip out, let's call them the top 10 stocks, and look at the PE, they're still trading at what, 15.5, 16 times earnings, and you're potentially heading into a situation where we've already got a little bit of an earnings recession going on. So isn't it also fair to say that the top end of town is seeing that irrational exuberance coming in, but it's not necessarily guaranteed that what everyone's expecting in terms of this middle order melt up is going to happen, that if anything, if those top 10 go down, then everything goes down?
Yeah, well, again, if you look back at like the past bubble, the coup de grace of bubbles, 1999, if you bought small cap value, if you bought REITs, if you bought companies, well, you still made money. And as I said earlier, the average stock outperformed the S&P by 8.6% per year for 5 years. So we don't think you necessarily have to run for the hills, but you do have to be careful. I mentioned Comcast at 10 times earning. We also own like a Miller Knoll at roughly 10 times earnings. I mean, there are stocks you can find that are actually cheap right now. The average stock actually is at 18 times earnings, so the average stock is not necessarily cheap, but there are plenty of stocks that are reasonably priced. In terms of a recession, if you had a recession, the other theme that we're sticking with is companies with very resilient earnings, companies with high predictability in their earnings. So if we have a recession, that you're not going to have a big dip